Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories behind corporate financial filings with a smirk and a healthy dose of skepticism. Today we are diving deep into Healthcare Triangle Inc. Its latest quarterly report, and let me tell you, it is a wild ride of growth acquisitions and a whole lot of financial maneuvering. Think of this as your cheat sheet to understanding exactly what is going on with HCTI. Before we begin, if you love getting straight to the point insights from these complex documents, smash that subscribe button. We break down what really matters so you don't have to. And hey, we have a fantastic community over on our Discord channel linked in the video description. Come join the conversation. So what are we looking at here? This is Healthcare Triangle Inc.'s financial update for the third quarter ending the 30th of September 2025. Think of it as a checkup on the company's health. Are they growing? Are they spending wisely? And what are the big moves they've made lately? Healthcare Triangle is in the business of providing it and data services specifically for the healthcare and life sciences industry. They aim to help healthcare providers and pharma companies use technology to improve patient outcomes and streamline operations. They are big on cloud digital transformation and data. First up, let's look at the balance sheet, if you will. As of the 30th of September 2025, the company had total current assets of about $7.9 million. Compare that to just $1.9 million at the end of 2024. That is a significant jump, folks, primarily driven by a huge increase in cash and a big spike in amounts owed to them called accounts receivable. They also added something interesting called goodwill and other intangibles to the tune of nearly $5.9 million. This usually means they acquired another company or its assets and paid more than the tangible stuff was worth, which points to future growth potential or brand value. On the flip side, they also have liabilities. Total current liabilities were around $3.9 million. What stands out here is this item called contingent consideration, which went from $500,000 to $1.2 million. This means they likely made an acquisition and part of the payment depends on how well that newly acquired business does in the future. It's like saying, hey, we'll pay you more if you hit these targets. Now let's talk about the scorecard, the income statement. For the 3 months ending the 30th of September 2025, revenue was about $3.5 million. This is up from $2.4 million in the same period last year. That is a solid 45% increase. Not too shabby. And for the bigger picture, looking at the 9 months ending the 30th of September 2025, revenue was over $10.7 million, up 13% from the previous year. So yes, growth is happening on the top line, but here is what we need to watch. Cost of revenue also shot up for the quarter. It was $2.9 million compared to $1.7 million last year. That is a 70% increase. This is why their gross profit margin took a hit. For the 3 months ending the 30th of September 2025, it was just 18% down from 30% in the same quarter last year. For the 9 months, it fell to 13% from 27%. This means for every dollar of revenue they brought in, they had to spend a lot more on the direct costs of delivering their services. The report says this is partly due to acquisitions made where contracts were negotiated at lower margins. This is a classic integration challenge. You acquire a company and inherit its less profitable deals. The good news, according to management, is that new contracts are being negotiated at higher margins, so we should see that gross profit percentage climb back up. Operating expenses are also a key area. Sales and marketing costs jumped dramatically from $294,000 to over $1 million for the quarter. That is a 248% spike. They are clearly investing heavily in getting the word out about their services and acquiring new customers. General and administrative expenses also doubled from $1.1 million to over $2 million for the quarter. This is also a 94% increase. This often includes things like corporate overhead salaries for finance and HR and legal fees. When a company grows rapidly, these costs tend to rise significantly. All this investment and increased costs led to a net loss. For the quarter ending the 30th of September 2025, the company reported a net loss of $1.9 million. Last year for the same quarter, the loss was $1.2 million. So the loss widened. For the 9-month period, the net loss was nearly $5 million. While revenue is growing, the costs are growing even faster right now. A significant event impacting these financials was an acquisition on the 16th of June 2025. Healthcare Triangle acquired Ezovion Solutions Private Limited, a hospital information systems SaaS provider. The deal was worth $5.7 million paid through a mix of cash stock and an earn-out payment. This acquisition is a big part of that goodwill number we saw earlier and is intended to expand their market reach. Now, for something interesting, companies often have transactions with related parties, meaning other companies where they have common ownership or control. Healthcare Triangle has dealings with Secure Cloud Technologies Limited and its subsidiaries. As of the 30th of September 2025, they had about $3.5 million due from these affiliates. This is up from less than $500,000 at the end of 2024. The report mentions that Secure Cloud Technologies Limited took over some of these obligations. This is an area to keep an eye on to ensure these related party transactions are fair and transparent. Looking at the equity section, the company has preferred stock. They issued 1.6 million shares of Series B convertible preferred stock for about $7.4 million as part of a transaction involving assets from Secure Cloud Technologies Inc. This looks like an internal restructuring or asset transfer between related entities. On the debt side, the company paid off its convertible notes. At the end of 2024, they had about $2.1 million in convertible notes payable. By the 30th of September 2025, this balance was zero. This means they either paid off the debt or converted it into stock, effectively reducing their debt burden. They also have warrants outstanding. In late 2023, they issued warrants to purchase stock in connection with a convertible note. As of the 30th of September 2025, there were still nearly 3.9 million warrants outstanding, with an average exercise price of almost $2,000 and an average remaining term of over 2 years. These are essentially options for investors to buy stock at a certain price and could dilute existing shareholders if exercised. And finally, earnings per share. Because the company reported a net loss, basic and diluted earnings per common share for the quarter was negative 42 cents. For the 9 months, it was about negative $2.23. This just reflects the company's current profitability or lack thereof. So what is the big picture here? Healthcare Triangle is definitely in a growth phase. They acquired a company, added significant assets, and are investing heavily in sales and marketing. The revenue is increasing, which is positive. However, the costs are rising even faster. Their gross margins are squeezed, and they are reporting net losses. The increase in related party balances and the significant spend on acquisitions require careful monitoring. The company's strategy seems to be focused on expanding its software services and managed services. While the managed services segment saw a slight revenue dip this quarter, the company is aiming to shift more towards recurring revenue streams, which generally leads to more predictable income. The challenge will be to translate this revenue growth into actual profitability. They need to manage their costs effectively, especially after integrating new acquisitions. The significant sales and marketing spend suggests they are very aggressive in pursuing new business, which could pay off long term but is currently hurting their bottom line. In conclusion, Healthcare Triangle is an aggressive growth company. They are making bold moves with acquisitions and market expansion. The current financials show that this growth comes at a cost with widening losses and squeezed margins. However, if they can successfully integrate their new assets, manage their expenses, and convert their revenue gains into profit, their ambitious strategy could pay off in the long run. It is a high-risk, high-reward situation. Alright, that is our deep dive into Healthcare Triangle's latest report. What are your thoughts on their growth strategy and these numbers? Let us know in the comments below if you found this analysis helpful. Give this video a like and subscribe for more decoded financial reports. And seriously, join our Discord community. The link is in the description for more exclusive content and discussions. Thanks for watching. See you next time on Corporate Decoder.